ETFs with dividends. An ETF is an extra toasty fry. ETF stands for Easily Transferred Fungus. Extreme toe fetish? Okay, this is still the wrong channel, guys. Follow me on OnlyFans. Oh my god, okay, are we ready? Okay. An ETF, or exchange-traded fund, is one of the most important tools in any lazy investor's portfolio. ETFs offer the diversification, accessibility, and tax benefits, which makes them an easy choice for everyone from the novice to advanced investors. But not without any risk. Let's take a look at everything you need to know about ETFs to make an informed decision about where you invest your money. And stay till the very end for a special link to our toe fetish forum. Okay, seriously, who's running the teleprompter? Okay, well, can you please stop? You're making me sound like an asshole. What is an ETF? If you're familiar with mutual funds and index funds, then you probably have a good idea of what an ETF is. Similar to mutual and index funds, an ETF is a basket of securities that shareholders can invest in. An index typically refers to a hypothetical clustering of stocks, like the 500 largest stocks in the U.S. market. An exchange-traded fund is a computer-generated cluster of stocks that you can buy in small pieces. This is like a ticker symbol, VOO or SPY, which you can use to buy the 500 largest stocks on the U.S. market. An ETF provider curates a collection of assets, including stocks, bonds, commodities, or currencies, and creates a unique ticker for investors to trade. When you buy a share of an ETF, you're buying into the whole collection of assets in that ETF. This provides the investors with the benefit of diversification that they wouldn't get if they simply purchased a single stock. Once purchased, the ETF can be traded at any time by the investor, just like a regular stock. Well, now let's answer a question you're all dying to know. How do I make money by investing in ETFs? And will they make me rich? You can certainly make a lot of money investing in ETFs, but it's unlikely that your portfolio of ETFs is going to be your get-rich-quick scheme. You can mainly make money investing in ETFs in one of two ways. The first is by selling your ETF at a profit. Like a stock, an ETF's price can fluctuate based on how the market values the assets that comprise the fund. Therefore, an investor can sell their share in the ETF when the price is higher than the price they purchased the ETF at in order to make a profit. So, if you purchase 2 shares at $10 each and sell your shares at $30 each 5 years later, then the ETF just made you $40 in total, before taxes. And we'll get to taxes in a minute. The second way you can make money by investing in ETFs is by receiving dividends from the fund. A dividend is a regular payment that a company makes to share profits with its stockholders. This is typically done by companies that are either very mature and don't have much room to grow by reinvesting into the company, or for companies in some niche markets who are contractually required to share their profits as dividends. This is common for real estate investment trusts, master limited partnerships, business development companies, and closed-end funds, which would need a video all their own. If you're interested in a dedicated video on those 4 types of stocks, say so in the comments. Okay, moving on. The 2 most common are stock dividends and cash dividends. A stock dividend is when, instead of paying you cash, the fund owner pays investors with additional shares in the fund. This is also called a dividend reinvestment program or plan, DRIP for short. A cash dividend is when the fund owner pays the shareholder in cash, directly to the shareholder's brokerage account. If the fund is paying dividends, this provides investors with the opportunity to participate in dividend investing, which I personally think is great for newer investors. While dividend investing might invest more in some sectors like utilities, finance, or real estate because they tend to pay high dividends, most dividend investors will still diversify their portfolio. And while a high dividend yield is good, all other things being equal, all other things probably won't be equal. Chasing stocks with a high dividend yield can easily become a fool's game. A company whose stock is crashing due to financial hardship may increase the dividend more than they can afford to try to draw in investors, so that they can take out loans against their own stock value to then fix the company. Debt is a useful tool to be sure, but it's also dangerous to take out more debt because your budget is struggling. Therefore, investors should investigate a company's free cash flow, historical dividend payout, and other metrics of financial health in order to ensure that the company will be able to pay consistent dividends. If you see an individual stock or fund paying more than a 10% yield, you should scrutinize it closely before making the decision to purchase. Not that it's always a bad idea. You could just be catching the business during a bear market when they have a low stock price but have managed to maintain their normal dividend rate. Some investors are different. Hey, you can YOLO into companies solely based on how high their dividend yield is if you're that type to shotgun Red Bull in the morning just to feel something. If you are the kind of investor who enjoys laying around on a Sunday with a cup of decaffeinated tea, then a more mild investment strategy might be more appealing. This approach is for lazy investors who want to put their money into an ETF and forget about it. Taxes. Remember when I mentioned taxes earlier? You can sometimes set up a dividend reinvestment plan with your brokerage account. For normal humans, this is great because you never need to think about your portfolio. It will automatically keep buying more stock for you. However, this also counts as a taxable event because you technically received the money, even if the brokerage account then immediately spent it. Depending on if you receive qualified dividends or ordinary dividends, how long you've held the stock, and how much dividend income you make that year, you could end up paying taxes on those dividends. However, most dividends are qualified, which, in short, means you probably won't pay taxes, and if you do, then it will probably be less than your income tax rate. But even if you do terribly at investing, you can sell your underperforming stocks at the end of the year to realize a loss. And that will reduce your tax burden because it decreased your income. Tax advantages and the difference in dividend types really deserve its own video. But in the meantime, there's a link in the description for further reading. Common ETF funds. Now that we bored you to tears with the tax talk, let's get down to the nitty-gritty. Which ETFs should you buy? Unfortunately, we don't have a one-size-fits-all answer to this question, but we can give you some ideas so you can create your own adventure. The S&P 500 is generally used as a health indicator for the U.S. stock market and is composed of the 500 largest companies in the U.S. stock market. Ticker symbol VOO is very popular to purchase this fund. VOO's current dividend yield is 1.7%. VOO has had an inflation-adjusted annual return of 8.61% since it was stood up in 2011. But if you want a more dividend-oriented version of the same fund, you could also purchase SPIDE, or SPIDER as I like to call it. SPIDE has a dividend yield of 4.31%. However, this fund is not dumb. It tracks a modified S&P 500 to focus on catching you dividends. However, SPIDE annual return, inflation-adjusted, is only 3.95%. This is still beating inflation, and the buzz of getting paid in dividends may help motivate you if you're not a consistent investor yet. That said, I've also built my own dividend income ETF of sorts as a pie in M1 Finance. There's a link below if you'd like to use that pie for your own investing. You can also make modifications if you would like to just use it as a starting point. Not all funds or companies used in this fund are older than December 31st, 2020. Backtesting is difficult because the fund is so young. However, the fund currently has a 9.78% dividend yield and has outperformed the above two ETFs since its inception. In this graph, Portfolio 3, the orange one, is my personal dividend portfolio. Portfolio 2, the red one, is SPIDE, and Portfolio 1, the blue one, is VOO. However, losing less money is not particularly impressive. Who should invest in ETFs? If you're an aggressive investor who likes to invest actively, you can add ETFs to your portfolio and use them to potentially make quick gains if you either choose an aggressively high dividend yield ETF or a leveraged ETF. We'll talk leverage another day. So you should probably subscribe to Relentless Growth to ensure you get to see that video. But if you're a lazy investor who wants to dump their money in a fund and forget about it, ETFs can also be used as a low-risk, easy investment. ETFs are a fantastic way to diversify your portfolio and intelligently invest your hard-earned money. And the dividend-oriented varieties ensure that you experience some tangible gains in months rather than years. So don't sit around waiting for something to happen. Treat your easily transferred toe fungus today. Yeah, fucking teleprompter guy, you're fired! You only have one life to live. Grow it relentlessly.